We're jumping straight into Planet Labs today. Everyone is watching the price action, but the real story is the explosion in their contract backlog and the shift toward defense intelligence.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we blast off, pun absolutely intended, make sure you hit that subscribe button and smash the like. It really helps us keep the lights on and the data flowing. We want to help you simplify this crazy market, so join the community.
Okay, let's get into it.
So, Planet Labs. If you've been watching this ticker over the last year, you are probably feeling pretty good.
Pretty good is an understatement. You're feeling euphoric.
Euphoric is the right word. The stock is up 395% over the past year. It's trading right near its 52-week high of, around $31?
Just about. Currently sitting around 27.
And a year ago, nobody saw this coming. Not this kind of rally. But here's the disconnect, and this is what we need to figure out. The stock is going parabolic, but on a GAAP basis, the company is still, technically losing money.
It's the classic growth versus profitability story. But you usually see this with a stock that's up maybe 40%, not almost 400.
Exactly. So I have to ask the big question right away. Is this all hype? Is it just the space economy narrative? Or have the fundamentals finally truly caught up?
I think they have. I think something fundamentally changed. And to see it, you have to look past the stock chart and look at the actual business.
So where do we start?
We need to talk about two things, the moat and the backlog.
Okay, let's do it. Start with the raw numbers. Q3 fiscal 2026.
Right. So they posted just over 81 million in revenue. That's 33% year-over-year growth.
Which is a serious acceleration from where they were, say, 2 years ago.
It is. And, the number that really jumps out at me is the gross margin.
Sitting at, what is it?
It's robust, between 57 and 60%. That tells me this business can really scale.
Why is that margin number so important?
Because it tells you what kind of business this is. If they were just building and selling hardware, satellites, the margins would be way lower, maybe 20, 30%.
Okay.
But 60% margins, that's a software company profile. That's a data company. It means for every new dollar they bring in, they keep 60 cents.
But still, 33% growth is nice, but it's not 395% stock appreciation nice. There's got to be something else.
There is. It's the moat. And for anyone listening who thinks Planet Labs is just, Google Earth but live, we need to break this down.
They're not just taking pictures.
No. They have a proprietary constellation, the SuperDove and Pelican fleets, that scans the entire landmass of Earth every single day.
That's the key right there, the daily scan.
That is the key. Think of it like a magazine versus a daily newspaper. Most competitors, they're like a magazine photographer. You have to hire them. Go take a picture of this port. They snap it, they send it back.
That's called tasking, right?
Right. Planet is the daily newspaper. They're photographing everything, everywhere, every day, whether you ask for it or not. They are building a daily searchable archive of the entire planet.
Which creates a data library nobody else has.
Nobody. And this creates massive switching costs. This is the concept that really explains why the business is so sticky.
Okay, so break that down. Why is it so hard for a customer to just cancel and go somewhere else?
You could, but it would break your AI's brain.
What do you mean?
Look, the customers, we're talking the U.S. Navy, huge agriculture firms, they aren't looking at these pictures with human eyes.
They're building models.
They're building AI models to count things, to predict things. And you have to train those models on planet-specific data, their resolution, their color calibration. It's like a data dialect.
So you're teaching your AI to read their specific handwriting.
Bingo. If you try to switch to a competitor, you break your entire model. You have to start from scratch. That's an enormous switching cost. It makes leaving a technical and financial nightmare.
Okay, so the product is sticky, but let's talk about the fuel on this fire, the backlog. This is the stat that it just blew my mind.
This is the number. This is the signal.
Their backlog surged 216% to $735 million.
216%. It's not a gradual increase. It's an explosion.
It's coming from one place, isn't it? It's defense and intelligence.
Geopolitics.
Yes.
The world is tense, and governments need eyes everywhere, all the time.
Let's address that directly. Why now?
Well, it's a grim reality, but instability is good for the surveillance business. 2 years ago, Planet's pitch was about, saving rainforests.
The ESG angle.
Right. Today, that $734 million backlog is driven by the NGA, Swedish Armed Forces.
Yeah.
basically NATO-aligned interests. They've realized you can't be blind for 24 hours in the modern world.
And Planet is the only one with that daily newspaper.
Exactly. Look at the Swedish Armed Forces contract. That's a multi-year, low nine-figure deal.
So over $100 million.
From one country. That's a massive validation. When a government signs a deal that big, they are integrating you into their national security infrastructure. You're not a startup anymore. You're critical infrastructure.
And it's not just about the pictures anymore, is it? Let's talk about the tech integration, the NVIDIA jets and chips on the satellites.
This is a huge deal. And again, it sounds like a buzzword, AI in space, but it has real bottom-line impact.
So it's not just marketing fluff.
Not at all. The old model was you take a picture of the ocean, it's 99% water, 1% ship. You have to download that whole massive file to Earth.
Which is slow and expensive.
Incredibly. Now, with the NVIDIA chip on board, the satellite takes the picture, processes it in orbit, finds the ship, and just sends down a tiny little packet of data. Ship located at these coordinates.
So they're not selling photos anymore. They're selling answers.
They're selling answers.
Yeah.
And they are flashing their own bandwidth costs. That's where the margin expansion comes from. Plus, they're partnering with Alphabet on AI applications. It's a whole new level.
Okay, so what about the balance sheet? Can they afford all this expansion?
They're in a great position, actually. They have about $677 million in cash. And they made a really smart move, raising $460 million in convertible debt.
Debt can be risky, though.
Usually, yeah. But get this. They locked it in at a 0.5% interest rate.
0.5%.
In this economy, that's basically free money. It was a masterclass in timing.
Okay, that's a very, very compelling bull case. Revenue up, backlog exploding, cash rich, embedded with defense. But this is the easy money show. We have to look at the other side.
Let's break that down even further and look at the risks lurking behind that chart. Because when a stock runs almost 400%, you have to ask, is it too hot?
And it is hot. The stock is trading at 28 times sales, not earnings, sales. That's a massive premium.
Let's put that in perspective. 28 times sales means if the company gave you every single dollar of revenue, no salaries, no costs, it would take you 28 years to get your initial investment back.
Ouch. Yeah, when you put it like that.
It's pricing in absolute perfection. Any stumble, any slight miss on growth, and that multiple could get cut in half. Brutally.
And it seems like some of the insiders might agree. There's been a cluster of selling recently.
There has. And the optics on that aren't great.
Let's get specific. Director Robinson, Director Gadd, the president, and CFO Johnson, and Director Schingler, all selling.
Schingler sold, was it 1.4 million in December? And Johnson sold $4 million.
Right. And I know what you're going to say. To be fair, most of these are 10b5-1 plans, pre-planned sales.
That's legal reality, yes.
It's the legal reality, sure. But let's be real. You set the plan. You tell the broker, hey, if the stock hits $25, sell this much.
A fair point.
So if the CFO, the guy who knows the books inside and out, sets a trigger to dump $4 million worth of stock at 20 bucks, he's telling you he doesn't think it's going to 50 anytime soon.
Or he's just diversifying. But I take your point. When insiders are taking chips off the table during a massive rally, it's definitely a reason to pause.
Okay, let's talk about the bottom line, the profitability puzzle. Because they talk about being profitable, but I see a big net loss.
This is where you have to understand adjusted versus GAAP accounting. The good news is they just had their fourth straight quarter of positive adjusted EBITDA. About $5.5 million.
Which means the core operations are generating cash.
Right, before certain expenses. But the GAAP net loss was $59.2 million in Q3. That is real money going out the door.
So where does that huge $60 million gap come from?
A lot of it is stock-based compensation. They're paying their people in stock. It doesn't use cash, but it is a real expense to shareholders.
Which leads right to the next big risk. Dilution.
The silent killer of returns.
Because the stock price doing so well actually triggered these earn-out milestones from their SPAC deal, right?
Exactly. The deal said, if the stock hits this price, early investors and founders get more shares. Well, it hit the price. So we saw over 5.7 million new shares hit the market.
And the total is over 11 million.
It is. So if you're a shareholder, your slice of the pie just got smaller. You're paying a huge premium, and your ownership is being diluted while you wait for real profits.
So a huge growth story clashing with a huge valuation and dilution risk. What should people be watching for in the next, say, 30 to 60 days?
We have a pretty packed catalyst calendar coming up.
First on the list has to be earnings.
Absolutely. Q4 fiscal 2026 earnings are expected in late February or early March. The market wants to see revenue between $75 and $80 million.
And if they miss that number?
With a 28 times sales multiple. Look out below. A miss will not be forgiven. They have to hit or beat.
And beyond the top line, we're watching product rollouts. The new Pelican satellites launched in November, and there's the Owl constellation.
Right. Investors need to see that the data coming off these new birds is actually being sold. Are these new assets generating revenue yet? Or are they still just costs?
And then there's the rumor mill. We can't invest on it, but we have to talk about the buzz around orbiting AI data centers.
This ties back to that Alphabet partnership. There's some chatter that this could be a deeper hardware play.
What does that even mean, an orbiting data center?
Well, think about those NVIDIA chips. If you have enough processing power in orbit, you could run complex AI models in space for clients who need zero latency.
Like a battlefield commander.
Exactly. If Planet can offer that kind of compute power, they stop being a data company and start becoming a cloud provider that happens to be in orbit.
Okay, let's bring it all home. What's the lowdown here?
The summary is this. Planet Labs is now a high-growth defense intelligence play. They have a massive $700+ million backlog and a real data moat. But the price of entry is very steep. You're paying 28 times sales, facing dilution, and still waiting for real GAAP profitability.
It really feels like they've proven the tech works. They've proven governments want it. Now they just have to prove they can make money for shareholders.
That's it, exactly.
Yeah.
They've bridged the gap from science project to defense contractor. Now they have to bridge the gap to profitable compounder.
Which brings me to the final question I want to leave everyone with. As they integrate these NVIDIA chips, as they get closer to Alphabet, you have to ask yourself, is Planet Labs actually a satellite company anymore? Or are they becoming an AI data center that just happens to be in orbit?
That is the multi-billion-dollar question, isn't it? If the market decides their AI infrastructure, 28 times sales might look cheap in 5 years. If not, it's a long way down.
A lot to think about. Thanks for tuning into the Easy Money Show.
And remember, none of this is financial advice. Always do your own research.
We'll catch you on the next one. Peace.